Welcome back to We Are Cosmic. If you are here for real conversations around finance, cryptocurrency, and how the global system is quietly changing, you are in the right place. Today's video is important because it focuses on something that many people in the crypto space are still not paying close attention to, and that is Ripple's push to become a full-fledged bank. At first glance, that idea may sound surprising. Ripple is already working with banks all over the world, so the natural question becomes, why would Ripple want to become a bank itself? What would that change? And more importantly, why does this matter for the future of digital finance as a whole? In this video, we are going to break that down step by step using simple language and clear logic because the implications here are much bigger than most people realize. Recently, something dropped that significantly increases the chances of Ripple moving in this direction successfully. It came from one of the most powerful but least talked about regulators in the financial system, the Office of the Comptroller of the Currency, also known as the OCC. This is the U.S. authority that oversees national banks. When this institution speaks, banks listen. Markets listen, and yes, crypto companies listen as well. What was said by the new leadership at the OCC changes the tone completely. The message was simple, but extremely impactful. Crypto companies should not be treated differently than traditional companies when applying for federal banking charters. That one statement removes a major psychological and regulatory barrier that has held back digital asset companies for years. Suddenly, the path for a company like Ripple looks a lot more open than it did before. This is not speculation about price. This is not hype. This is about structure, regulation, and long-term positioning inside the global financial system. Ripple becoming a nationally chartered bank would represent a shift from being just a technology provider to becoming foundational financial infrastructure. That distinction matters more than numbers on a chart ever could. Before we go deeper, there is something else we will touch on later in this video that always sparks debate inside the XRP community: the riddles. Some people dismiss them completely, while others believe they carry meaning. Instead of extremes, we will take a grounded and historical perspective and explain why cryptic signaling has existed for centuries during periods of financial change. Not prediction, not magic, just communication in a different form. Stay till the end for that segment because it adds context rather than confusion. Coming back to Ripple, one reason this topic is so critical right now is because regulatory leadership across multiple agencies has quietly shifted. We have already seen more open attitudes toward crypto at the SEC and CFTC, but the OCC was the missing piece. Banking regulation is where real power lives because banks are the pipelines of liquidity. Without access to that system, innovation always hits a ceiling. Ripple understood this early. That is why it applied to become a nationally chartered bank long before most people were even discussing the concept seriously. Becoming a bank is not about replacing banks. It is about speaking the same regulatory language, operating under the same oversight, and removing friction that slows down adoption. In the digital asset world, trust is built through compliance, not rebellion. This is what we are going to explore in this series: why Ripple wants this status, what it unlocks, how it changes its role from a back-end service to a platform banks can fully integrate with, and why this aligns perfectly with Ripple's broader goal of building next-generation settlement infrastructure rather than just payment rails. So take a moment, settle in, and let's break this down properly. Because when platforms, regulation, and infrastructure start aligning at the same time, history shows that something much bigger is usually being built behind the scenes. To really understand why recent developments are so important for Ripple, we need to slow down for a moment and talk about the Office of the Comptroller of the Currency, or the OCC. This is not a regulator that gets a lot of headlines in the crypto space, but in the traditional financial world, it carries enormous weight. The OCC is responsible for supervising and regulating national banks in the United States. Any institution that wants a national banking charter must go through this office. For decades, the OCC has acted as a gatekeeper. It decides who is allowed into the federal banking system and under what conditions. That is why crypto companies being shut out of this process in the past was such a major limitation. They could build technology, they could partner with banks, but they could never fully operate on equal footing with them. That difference matters a lot when you are talking about liquidity, compliance, and direct access to financial infrastructure. What makes the recent shift so important is not just the wording, but the philosophy behind it. The new leadership at the OCC has made it clear that a company should be judged by its risk management, compliance standards, and operational soundness, not by whether it is labeled crypto or traditional. That sounds simple, but it is actually a huge change. It puts crypto firms into the same evaluation framework as banks, rather than keeping them in a separate and often more restrictive category. Ripple is uniquely positioned in this environment. Unlike many crypto projects that started with decentralization first narratives and figured out regulation later, Ripple built its business with institutions from day one. That means compliance, transparency, and regulatory engagement were always part of the model. Applying for a national bank charter was not a reactionary move. It was a logical next step. A federal banking charter does several things at once. First, it provides legitimacy in the eyes of traditional financial institutions. Banks do not like uncertainty. They operate in heavily regulated environments and choose partners that reduce, not increase, compliance risk. When Ripple operates under the same regulatory umbrella, that friction disappears. Second, becoming a federally chartered bank opens the door to access systems that normal tech companies simply cannot touch. One of the most important examples is the possibility of a Federal Reserve master account. This account allows direct interaction with central banking infrastructure, removing the need for multiple intermediaries. For a settlement-focused company, this is a massive strategic advantage. Third, the status changes how Ripple can structure products. Many services in the crypto space face limitations because they sit outside the traditional banking framework. Stablecoins, custody solutions, and cross-border settlement tools all face regulatory hurdles when the provider is not a bank. With a charter, those hurdles become guardrails instead of roadblocks. Another key point that often gets misunderstood is competition. Some assume Ripple becoming a bank would put it in direct competition with its partners. In reality, the opposite is true. Ripple is not trying to replace banks. It is trying to offer a banking-as-a-service layer tailored for digital assets. This allows traditional institutions to adopt new technology without re-engineering their entire compliance structure from scratch. Think of it like this. Instead of banks jumping blindly into crypto-native systems, they plug into an environment that already speaks their language. Same rules, same oversight, same expectations. That is how large institutions adopt change, slowly, carefully, and through trusted frameworks. This is why the OCC's position matters so much more than social media narratives. Regulatory alignment signals readiness. It shows that the system itself is preparing for integration rather than resistance. Ripple's application was early, deliberate, and strategic, and the environment is now moving in a direction that favors that kind of preparation. The digital asset world is fundamentally different. Crypto does not just upgrade messaging or record keeping. It touches value movement, custody, and settlement directly. Once a company operates at that layer, it begins to overlap with activities that, under current laws, are reserved for regulated financial institutions. This is where many crypto companies hit a natural ceiling. Ripple is not trying to build a side product. It is working to redesign how money moves at a foundational level. That means interacting with fiat currency, digital assets, liquidity pools, and settlement rails at the same time. To do that legally, efficiently, and at scale, the company cannot remain in a purely technology provider category. This is where bank status becomes essential rather than optional. Without it, Ripple must constantly rely on intermediaries. Each intermediary adds cost, delay, risk, and complexity. Worse, it creates points of failure that Ripple does not control. For a company focused on precision, speed, and reliability, that structure simply does not make sense long term. Another major factor is compliance. Banks are not resistant to crypto because they dislike innovation. They are resistant because adopting new technology can expose them to regulatory risk. Even if a tool is technically superior, banks will avoid it if compliance is unclear. This is why many financial institutions move slowly. Risk avoidance is embedded in their culture. By becoming a bank, Ripple removes that friction entirely. It no longer asks banks to stretch into unknown territory. Instead, it invites them into an environment that already meets the regulatory standards they live under every day. This is a powerful shift. It reframes the conversation from, is this allowed, to how quickly can this be integrated? There is also the question of stablecoins and tokenized assets. Issuing or managing digital representations of value requires strict oversight. Without bank-level authorization, companies are limited in what they can legally offer, regardless of technical ability. A charter changes that equation. It allows product development to scale without constantly worrying about regulatory boundaries being crossed unintentionally. What Ripple is effectively building is a regulated digital banking layer optimized for modern finance. This layer sits between traditional institutions and emerging digital asset markets. Banks can plug into it to settle transactions, manage liquidity, and interact with blockchain-based systems without exposing themselves to uncontrolled regulatory risk. This is especially important for cross-border settlements. Moving money across borders today involves multiple intermediaries, time delays, and reconciliation issues. Ripple's long-term goal is not just faster payments, but real-time settlement infrastructure that works globally. That kind of system requires coordination between jurisdictions, currencies, and regulatory regimes. A bank charter provides credibility and access that pure tech companies do not have. Another point often overlooked is trust. In finance, trust is not built through promises. It is built through oversight. A federally chartered bank operates under continuous supervision. That oversight is costly and demanding, but it creates confidence. For institutions managing billions in assets, confidence outweighs innovation alone. This is why Ripple's path makes sense when viewed through a long-term lens. The company is positioning itself not as a disruptor on the outside, but as an insider shaping the next version of the system from within. Becoming a bank is the foundation that allows everything else to function smoothly. Becoming a bank changes this dynamic completely. It shifts Ripple from being an external tool to becoming a shared financial platform. Instead of customizing itself around every institution, Ripple can offer a standardized, regulated environment that institutions plug into. This is a much more scalable model, especially on a global level. When platforms reach this stage, adoption accelerates. Banks prefer systems that reduce integration complexity, not add to it. A regulated platform allows financial institutions to onboard faster because many of the legal and compliance questions are already answered. That alone can shorten adoption timelines dramatically. Another important change is control. As a back-end service, Ripple depends on partners for access to key systems. As a platform, Ripple operates within those systems directly. This improves efficiency, reliability, and transparency. It also allows Ripple to innovate faster without needing approvals across multiple independent institutions each time something changes. This matters a lot when dealing with liquidity. Liquidity is the lifeblood of finance. Access to it determines what products can exist and how resilient they are under stress. A bank-level platform can manage liquidity more intelligently because it operates at the settlement layer rather than the messaging layer. That distinction separates true infrastructure from helpful software. Ripple has consistently emphasized settlement, not just payments. Payments are instructions. Settlement is the actual movement of value. Most of today's financial systems still settle slowly using outdated processes developed decades ago. Ripple's approach aims to compress settlement time while maintaining regulatory clarity. With bank status, Ripple's technology moves closer to the core of the financial system. That means it can serve as a neutral bridge between institutions rather than a custom add-on. Neutrality is important. Banks are cautious about adopting solutions that favor competitors. A regulated platform with clear rules reduces that concern. Another advantage of platform status is consistency. One of the biggest challenges in cross-border finance is fragmentation. Different rules, different systems, and different standards slow everything down. By operating under a unified regulatory framework, Ripple can offer a consistent experience across markets. That consistency is extremely attractive to global institutions. There is also a psychological shift. When a company becomes regulated at the same level as its clients, conversations change. The relationship becomes peer-to-peer rather than vendor-to-client. That changes how contracts are negotiated, how risks are perceived, and how responsibility is shared. This is why Ripple becoming a bank is not just a legal upgrade, it is an architectural transition. It transforms Ripple from a service provider into a financial network with formal standing. That network can support a broader range of products, handle larger volumes, and integrate with legacy systems more seamlessly. At this point, it becomes clear that Ripple is not positioning itself for short-term relevance. It is positioning itself to be part of the next generation of financial infrastructure where digital assets, fiat systems, and regulatory frameworks coexist rather than compete. Now that we have covered Ripple's strategy, regulation, and platform evolution, it is time to address a topic that constantly shows up in the XRP community and often creates confusion: the riddles. Some people dismiss them completely. Others treat them as predictive messages. Both approaches miss the bigger picture. To understand what is really happening here, we need to look at history rather than emotion. Throughout history, major financial shifts were rarely explained openly while they were happening. Large changes to monetary systems involve governments, institutions, and power structures. Open communication is usually restricted, not because of secrecy for secrecy's sake, but because premature disclosure can destabilize markets or political relationships. As a result, indirect signaling has been used repeatedly across different eras. These signals were never about predicting exact outcomes. They were about acknowledging change, preparing certain audiences, and guiding attention without explicit announcements. Literature, symbols, cartoons, archetypes, and coded language have all been used in periods leading up to major economic transitions. This is not speculation, it is documented history. The example involving the Roosevelt Bears is particularly interesting when viewed through this lens. Before the establishment of the Federal Reserve, cultural material began familiarizing the public with concepts related to finance, centralized banking, and institutional power. These were not forecasts, they were narratives preparing society for structural shifts. When people point to similarities between historical examples and modern cryptic messaging, the mistake is assuming intent must be supernatural or predictive. In reality, it can simply be informational signaling. Highly intelligent individuals, especially those familiar with cryptography, storytelling, and systems design, often communicate ideas indirectly when direct communication is not appropriate or allowed. Another important concept is archetypes. Human societies across unrelated cultures have repeatedly used similar symbols to represent thresholds, guardians, transitions, and initiation into new systems. These symbols appear in mythology, religion, storytelling, and art. They exist because the human mind responds to pattern and metaphor more strongly than raw data. The discussion around threshold guardians fits into this context. These figures represent obstacles that test readiness before entry into a new world or system. In storytelling, the guardian is not an enemy, it is a filter. Only those prepared pass through with understanding rather than fear. When viewed this way, modern symbolic communication around financial transformation starts to make more sense. It is not about instructions or predictions. It is about framing change in a way that supports psychological acceptance. Large shifts fail when societies are unprepared for them, regardless of technical readiness. It is also important to recognize that many of the individuals involved in cryptography, finance, and systems theory enjoy layered communication. This is not manipulation, it is cultural. Code, abstraction, and metaphor are natural extensions of how these communities think and communicate. That does not mean every riddle carries meaning, and it does not mean everyone should focus on them. What matters is understanding why this form of communication exists at all. It exists because humans have always used symbolism to bridge the gap between complex systems and public understanding. Seen through this lens, the riddles are not central to Ripple's strategy, XRP, or market mechanics. They are a side narrative that reflects historical patterns during times of structural evolution. Whether someone pays attention to them or ignores them does not change the underlying infrastructure being built. When you step back and look at everything together, a clearer picture begins to form. Ripple's push to become a federally chartered bank is not an isolated decision. It connects regulation, technology, institutional behavior, and historical patterns of financial change into a single narrative. This is what makes the current moment so significant. At its core, Ripple is not trying to build a better version of the existing system. It is trying to rebuild how settlement works in a world where value is digital, global, and instant. Traditional banking infrastructure was not designed for this environment. It was built for a slower world, with geographic boundaries and batch-based processing. Updating pieces of it helps, but it does not solve the core limitations. This is why regulation plays such a central role here. Large-scale financial change only succeeds when it is supported from the inside. Technology alone cannot replace trust. Trust comes from clarity, oversight, and shared standards. By aligning itself with regulators rather than avoiding them, Ripple is positioning itself within the system rather than against it. A federally chartered structure allows Ripple to meet institutions where they are. Banks, payment providers, and governments require certainty. They need defined rules, known risks, and predictable frameworks. When those conditions are met, adoption becomes a matter of engineering and integration, not ideological debate. This is also where XRP fits into the broader context. XRP is not being treated as a marketing tool or a speculative asset within this framework. It is part of an infrastructure conversation. Infrastructure does not need hype to be valuable. It needs reliability, efficiency, and consistency at scale. Those qualities are slow to build but powerful once established. The fascination around XRP extends beyond technology because it sits at the intersection of multiple worlds. It touches politics through regulation, economics through settlement and liquidity, and technology through decentralized systems. Even cultural narratives emerge around it, not because of fantasy, but because humans seek meaning during periods of transformation. This combination explains why conversations around Ripple and XRP feel different from typical crypto discussions. They are less about trends and more about architecture, less about disruption and more about replacement through evolution. These are the kinds of shifts that only become obvious in hindsight. None of this requires believing in predictions, timelines, or symbolic messages to understand. The measurable reality is that financial systems are modernizing, regulators are adjusting, and institutions are looking for pathways that do not compromise compliance or control. Ripple's approach aligns directly with those needs. The role of riddles, symbolism, or indirect messaging should be viewed as contextual rather than causal. They do not drive outcomes. They reflect human behavior around change. The real drivers remain policy, infrastructure, and institutional readiness. What makes this space compelling is not the promise of immediate outcomes, but the scale of what is being attempted. Creating a new settlement layer that works across borders, assets, and regulatory regimes is one of the hardest problems in finance. It is also one of the most valuable to solve. As this transformation continues, much of it will happen quietly. That is how infrastructure is built. By the time it becomes visible, it is usually already embedded. Understanding that process, rather than chasing noise, is what allows people to see the direction of change clearly. That is why this moment matters. Not because of hype, speculation, or mystery, but because multiple systems are finally moving in the same direction. And when regulation, technology, and institutions align, the results tend to reshape how finance works for decades to come.